With an adjustable rate mortgage, your interest rate resets every so often to adjust to the current market rates. So let's break down the components of an adjustable rate mortgage, and then I'll give you an example so you can see how it really works. An ARM loan has a lot more components. You have the initial interest rate, you have the adjustment interval, you have the index and margin, and the caps on changes in the payment or the rate. You have a ceiling and a floor. So let's get into it. The main component of an ARM loan is the adjustment interval, and that's the time in between interest rate adjustments. You might hear of a 6-month ARM or a 1-year ARM or a 5-year ARM, and that typically means that's how long in between rate adjustments. In commercial real estate, most ARM loans are hybrid, where they are fixed for, say, 5 years, and then the rate adjusts every 1 year. So you might hear the term 5-1 ARM or 3-1 ARM. Different lenders may call their loans different things, but typically you're going to have an adjustment interval at some regular frequency after the first adjustment. Now, the first adjustment happens after the initial interest rate or the teaser rate. They call it a teaser rate because that initial interest rate is typically the lowest that the rate will ever be during the life of the loan. So they're kind of teasing you with a low initial rate. The next component of an ARM loan is the index, and that is the market rate to which the loan is tied. That could be the Treasury bills, it could be SOFR, what was formerly LIBOR, and the index is the rate that they use to base the next rate adjustment on after they add the margin. So they take the index, let's say that is 4%, the bank will add a margin of, say, 2.5%. Now combine the two, and that's your interest rate for the next adjustment. The margin is the lender's spread, and that's always going to be the same. The index is what floats with the market rates, but the lender always tacks a specific amount onto the index to calculate the rate. The next component of an ARM loan are the caps, and the caps set a limit as to how far the interest rate can change up or down. Usually it's about 2 or 3%, which means that if your interest rate is at 5 and your caps are at 2%, means your next adjustment, your interest rate can only go up from 5 to 7, even if the market rate has gone higher. The interest rate caps put a limit on how much your interest rate can change at any adjustment. A lot of ARM loans also have payment caps, saying your payment can only change by a certain amount of the previous payment on any adjustment. Interest rate caps and payment caps prevent what's called payment shock, which is when a borrower's payment jumps so much in one adjustment that suddenly they have trouble making their payments. And then finally, the last components are what they call the interest rate floor, which is the minimum that the rate can ever be. Usually it's right around the teaser rate or a little bit higher, and an interest rate ceiling, which is the maximum the interest rate can ever be, regardless of what the market rates are. The ceiling and the floor are set throughout the life of the loan from the beginning. Now let's take a look at a real-life example of an adjustable rate mortgage loan and see what happens to the payments over time. Let's say we have a $500,000 ARM loan. It's a 5-year ARM, and it starts with a 4% teaser rate. The ceiling on this loan is 10%, 3% floor, and the interest rate change caps are 3%. So the rate can't go up or down by more than 3% in any given interval. Just like I teach all my students, if you have any 3 of these numbers, you can figure out the other 2. So we have a 30-year loan, change that to monthly, so 360 months. We're going to start out with a 3% teaser rate, so that's quarter point per month. You always have to put in the periodic interest rate. We have a $500,000 loan amount. We want the fully amortizing payment, so we set the future value to 0. So our payment is going to be $21.08 for the first 5 years. 5 years is 60 months, and at the end of 60 months, we will have a $444,000 balance. So at the end of 5 years, the interest rate is going to reset, at which point the lender will take the index plus the margin and calculate the new interest rate, and typically they'll round it to the nearest 1/8%. Let's assume that the new first adjustment rate is now 6%. The lender will take the current balance, which is $444,000, and they will recalculate the payments based on the amount of time left on the loan, which in this case is 25 years or 300 months. So they'll take the balance and make that the new loan amount with 300 months left and a 6% interest rate. The new payment is $28.64. So the payment went up about $750. That will be the borrower's payment for the next 5 years. 60 months later, the new balance will be $399,776. There's 20 years left on the loan, so that's 240 months. Let's say the rate went down to 5%. They're going to take the $399,776, and we get $26.38, and so on and so forth. So at each adjustment interval, the lender takes the balance and recalculates the payment as if for a new loan for the remainder of that 30 years. So now let's look at the pros and cons of an adjustable rate mortgage. The first pro is you get a lower initial interest rate and payment, thanks to that teaser rate, and that gives you potential savings. On the flip side, the nature of an ARM loan means that you're going to have rate increases because the teaser rate is set artificially low. And the other one is uncertainty, and that equals risk. If you're a long-term holder of this property, you don't know what your interest rate is going to be, and so you can't predict your payments as well. Makes it harder for budgeting. So how do you know if an ARM loan is right for you? Obviously, nobody has a crystal ball, and you can't always tell what's going to happen with interest rates in the future. The answer depends on your goals and your risk tolerance. If you only plan on holding the property for a short period of time and you aren't worried too much about the risk of your payment going up, an ARM loan can be a great option and you can save money in the long term. But if you plan on being on the property for a long time and you don't want the uncertainty of your payments fluctuating wildly, then an ARM loan might not be the best option for you. But if you do decide to get an ARM loan, there's one thing you need to be watching out for, because it's probably the biggest scam in all of mortgage lending, and that is called the option ARM. The option ARM gives you 4 different payment options. In the example I just showed you, you might remember our first payment was $21.08. They might give you an option of $1,600 a month, $1,250 a month, or maybe $1,100 a month. That might sound appealing at first, but remember, your interest accrues no matter what you pay. And here's what that does. That $21.08 payment, if this was your $500,000 loan over 30 years, that $21.08 payment would pay your loan down to 0 at the end of the loan. If you paid just $1,600 at the end of 30 years, you would not pay the loan down to 0. You would still have a balance left over. The $1,250 payment is the interest-only payment, so you wouldn't pay any principal down. At the end, you would still owe the same amount. And if you just paid $1,100 over time, your balance would actually go up. And that's called negative amortization. Borrowers who make the minimum payment on an option ARM have the highest foreclosure rates of any type of borrower. The option ARM is the epitome of predatory lending. So beware, because they won't always tell you the truth about these loans. If you're wondering how principal and interest are applied from your loan payments to your loan balance, check out my video following this one. And if you have questions, drop me a comment or reach out to me at Real Estate Finance Academy, where I'll give you plenty of insights to help you on your journey. Are you looking to get into commercial real estate and investment properties but can't find training that isn't mind-bogglingly boring? Then you've come to the right place. I'm Trevor Calton, and I will teach you about commercial properties with easy-to-understand, digestible lessons that will help you expand your business, close bigger deals, make more money, and dominate your competition.